Most market crashes announce themselves. They come with sirens. They come with headlines that scream urgency. They come with words like panic, emergency, crisis, or collapse. And yet, on this day, none of that happened. Prices collapsed, and the world continued scrolling. There was no breaking news banner, no emergency press conference, no clear explanation handed to the public. Nothing. Silence. The calm before, during, and after the storm was almost total, except in the markets themselves, where the storm was absolute. And that's what makes this event worth studying. Because when something this violent happens in silence, it usually means the mechanism behind it is technical, not emotional, structural, not reactive. Most crashes people experience in media reports are psychological. People panic, and that panic is contagious. But structural moves don't care how confident investors feel, how bullish social media is, or how euphoric analysts claim the market is. The machinery behind the move is invisible, and its impact is immediate and ruthless. On the surface, it looked deceptively simple. Precious metals sold off hard in a matter of hours. Silver dropped from $121 to $75. Gold fell from $5,600 to $4,700. And yet, in mainstream reporting, the day was described as a market correction. Analysts trotted out familiar phrases: markets overbought, healthy pullback, profit-taking. The narrative was that traders voluntarily decided to sell. But that is a story for the cameras, not the numbers. A correction implies choice. What happened here was different. There was no choice. There was compulsion. Large volumes hit the market almost simultaneously. Not staggered, not cautious. Mass blocks of contracts were liquidated within minutes. The kind of selling that occurs in small, calculated stages, where human emotion can influence decisions, was nowhere in sight. This was not a gradual unwinding of positions. It was mechanical, algorithmic, enforced. And that distinction matters, because markets don't just move on beliefs. They move on rules, written rules, encoded in exchange regulations, margin requirements, and automated triggers. To understand what really happened, you have to stop looking at charts and start looking at plumbing. Futures markets are not cash markets. They are leveraged systems built on collateral requirements. When you hold a futures contract, you are not paying the full value of the underlying asset. Instead, you post margin, a performance bond. This is the money the exchange holds to ensure that if prices move against you, there is enough collateral to cover losses. It's a small fraction of the total contract value, which is why leverage can multiply profits and losses so dramatically. Leverage is what gives futures their power, but it's also what makes them fragile. When margin requirements rise or positions are forcibly liquidated, the selling pressure can overwhelm even the largest market participants. Prices do not slowly decline under these conditions, they collapse. And the collapse does not require fear, speculation, or panic. It happens because the rules mandate it. Accounts are automatically liquidated. Positions are sold whether the holder wants to sell or not. Stop-loss orders cascade. Margin calls ripple. One enforced sale triggers another. And when thousands of leveraged positions are forced to sell at the same time, the market doesn't just react, it breaks. On the day in question, that is exactly what happened. Traders were blindsided, not by the market itself, but by the mechanical sequence of rules that triggered forced selling. Margin requirements had been increased repeatedly in the preceding weeks, creating a system-wide vulnerability. Traders who had been riding the rally in silver, some for months, suddenly needed far more collateral than they had on hand. For many, it was impossible to meet the requirement in time, and when they failed, their accounts were liquidated automatically. Positions were sold in milliseconds, flooding the market with supply far beyond what ordinary demand could absorb. This wasn't a trickle, it was a tidal wave. Within hours, hundreds of billions of dollars in value were erased. Silver dropped 37% in just 6 hours. Gold, the traditional safe haven, was not spared, dropping $900 per ounce in a day. Analysts framed it as a correction to keep the story palatable, but anyone paying attention could see that what happened was not voluntary. It was a mechanical execution, a forced cleansing of leveraged positions, carried out in cold, calculated order. Most investors will never see this from the outside. They look at a chart, see a steep drop, and assume it was fear. They interpret the move as sentiment-driven, as if the market collectively decided in a moment of irrationality that metals were too expensive. But the real driver was procedural. It was a sequence of mandated actions, a chain reaction triggered by margin rules. And once triggered, it cannot be stopped. Human intuition and judgment are irrelevant. You cannot negotiate with a margin call algorithm. You cannot plead with the system to give you more time. Once the cascade starts, it runs to its conclusion. If you want to understand markets at their most ruthless, study the moments when structure dominates sentiment, because in those moments the system itself becomes the agent of change. Not traders, not news, not analysts, just the rules. And when those rules push thousands of leveraged positions at once, that is when markets break silently and brutally. Looking closer at the events in the 6 weeks leading up to the crash, the pattern becomes clear. Multiple margin hikes were introduced by the exchange controlling silver futures, creating a fragile system. Even incremental increases in margin can be managed by traders. But repeated hikes, especially aggressive ones with little notice, act as a force multiplier. Every additional percentage point of margin compounds the stress on leveraged accounts. The system is like a chain with 100 weak links, and each margin hike snaps one more link until the whole structure collapses. December 12th marked the start of this sequence. Silver was surging, headlines were glowing, momentum was building. The exchange raised margin requirements by 10%. Traders barely noticed. Then came December 29th. Another hike, more aggressive, larger in magnitude. Overnight, obligations increased by 25%. And just 24 hours later, December 30th, yet another hike hit the books. In just 2 days, leverage conditions tightened drastically. By January 28th, only 3 days before the crash, the system shifted from fixed dollar margins to percentage-based margins. Accounts considered riskier were now forced to post up to 12.1% more collateral. 4 hikes in 6 weeks, totaling roughly an 80% increase in margin obligations, effectively a system-wide squeeze. For a trader, this is catastrophic. Margin is the money you need in your account to hold a futures position. It's collateral, not optional. If you cannot provide it, the system sells your position automatically. Imagine your landlord calling this morning and telling you your rent just went up 80% payable tonight, or you are evicted. That's essentially what happened in silver markets. Accounts without sufficient collateral were liquidated instantly. There was no negotiation. There was no grace period. The machines did it in milliseconds. And when thousands of accounts were liquidated simultaneously, the market itself became the executioner. This is why the collapse was so extreme. Silver fell from $121 to $75 in hours. Gold fell $900 in a single day. Human panic played little role. The destruction was baked into the rules, enforced automatically, without hesitation. The market wasn't finding fair value. It was obeying instructions. And yet, in the mainstream narrative, it was painted as a correction, an overreaction, a lesson in restraint and caution. But for anyone watching the mechanics, the lesson is something very different. Structure dominates sentiment, and leverage amplifies fragility to catastrophic extremes. It's also not the first time this has happened. History is littered with instances where margin rules and structural mechanics triggered extreme market movements. 1980 saw silver surge from $6 to $50 in a few months, driven by retail enthusiasm and institutional positioning. The response? The CME restricted leverage, effectively forcing cash-only purchases for many traders. Silver collapsed to $10. 2011 repeated the playbook. Massive gains, retail participation, institutional short positions under pressure, and once again, margins were raised repeatedly. Silver crashed from $50 to $26. Patterns repeat because structure repeats. The lesson is clear. Markets are not always driven by sentiment. When the mechanics of leverage, collateral, and rules converge, markets can move with absolute ruthlessness. Understanding that mechanism is critical for anyone who wants to survive, and potentially thrive, in these environments. While the paper market in the West collapsed under margin calls, something completely different was happening on the other side of the world. In Shanghai, vaults were draining. Not a few ounces here or there. Entire tons of silver were moving physically out of storage and into the hands of buyers. Unlike the futures market, where contracts and obligations can be created with a keystroke, physical silver is finite. It cannot be conjured, it cannot be margin called, it cannot be liquidated automatically by an exchange. Once it leaves the vault, it exists in the real world, tangible, immutable, and that is exactly what Chinese buyers were capitalizing on. China controls roughly 60–70% of global silver refining capacity. This is not mining. Mining merely extracts the metal from the earth. Refining converts raw ore into pure, deliverable silver, the kind that can be minted, traded physically, and used industrially. Without Chinese refineries, global silver supply chains effectively grind to a halt. Mines in Mexico, Peru, and Australia produce vast quantities of silver, but until it passes through a Chinese refinery, it cannot enter the international market in usable form. That makes China not just a participant in the market, but the gatekeeper. Controlling refining is controlling the flow of metal. And the strategy has been decades in the making. China has been quietly stockpiling, processing, and consolidating its grip on physical silver while Western markets focus on paper trading. For years, the West has treated silver as a commodity to be traded electronically: futures contracts, ETFs, margin accounts. It is easy, liquid, and manipulable. The paper system allows exchanges and institutions to control pricing without ever touching the physical metal. This is precisely why the margin hikes in January were so devastating. They strike at the leveraged paper positions, while the physical metal quietly accumulates elsewhere. On January 1st of this year, China made a decisive move. Silver was classified as a strategic national resource, on par with military-grade materials. This isn't symbolic. Export controls were immediately applied. Any silver leaving the country now requires governmental approval, ensuring that domestic reserves are secured first. The messaging is clear. This metal is vital, not just for industry, but for national security. It is a hedge, a weapon, and a strategic tool all at once. While American traders were being forced to sell their contracts, China was quietly controlling the flow of real silver, further widening the gap between paper and physical markets. The contrast could not be starker. In America, millions of leveraged traders watched their accounts liquidate. The system executed margin rules to the letter. Silver contracts fell 37% in a day. Meanwhile, in Shanghai, actual silver was being removed from vaults, delivered to buyers who wanted the metal in their hands, not a digital claim on it. This divergence between paper prices and physical availability is growing, and it tells us something profound about the nature of the global silver market. Paper can be manipulated, physical cannot. One exists only on screens, the other in the real world. The global implications are even larger when you consider the other metals and materials controlled by China. Beyond silver, China processes 90% of the world's rare earth elements, 98% of gallium, 80% of cobalt, and 60% of lithium. These metals underpin the modern economy: smartphones, data centers, electric vehicles, AI infrastructure, renewable energy technologies, military systems. The West depends on these supply chains for both civilian and military production. Control over processing means control over the global technological and industrial landscape. In effect, China has created a system where its control of refining and strategic stockpiling gives it leverage over both markets and geopolitics. By classifying silver as a strategic resource and restricting its export, they are effectively creating a parallel economy where physical metals matter more than digital prices. This contrasts sharply with the U.S. approach, where the paper price dominates. Futures contracts, ETFs, and margin positions dictate perceived value, often entirely divorced from actual supply and demand. The U.S. system can manipulate prices, but it cannot manufacture metal. The divergence between paper and physical prices is therefore becoming not just a market anomaly, but a geopolitical signal. The timing of this shift is critical. Central banks around the world are moving in parallel. In 2025 alone, central banks purchased over 800 tons of gold. Physical metal, not treasury bonds, not digital claims. Gold purchases have surpassed U.S. treasuries for the first time in decades, signaling a profound loss of faith in the dollar. The U.S. has long relied on the global demand for dollars to finance its debt and maintain influence. When central banks begin preferring gold over dollars, it represents the first cracks in a 50-year financial superstructure. Silver is part of the same story: a tangible asset, a hard currency alternative, a hedge against paper money. When America raises margins to crush silver prices, it is not just about controlling a commodity. It is about defending the dollar, defending a system, defending a narrative. The physical scarcity is striking. Prior to the crash, mints worldwide were struggling to meet demand. Perth Mint in Australia suspended wholesale orders. The U.S. Mint halted Silver Eagle sales. Dealers defaulted on deliveries because supply was insufficient. All of this occurred while paper silver was trading at $121. By Friday, when the price had been mechanically crushed to $75, physical demand did not disappear. Try to buy silver in ounces today. You will encounter record premiums and limited availability. The gap between paper and physical prices has never been wider. This isn't just an anomaly. It is a structural fracture in the market. Paper prices can be manipulated overnight, but physical availability cannot. The implications of this divergence are profound. For one, it highlights the difference between two competing market philosophies: the paper-dominated West versus the metal-dominated East. In the West, price discovery is largely abstract, mediated by futures contracts, margin requirements, and ETFs. The actual metal can sit in vaults for years, while the paper price fluctuates wildly. In the East, particularly China, the emphasis is on possession. Ownership of real deliverable metal ensures not just wealth, but security, industrial continuity, and strategic leverage. This is why the same playbook that crushes paper prices does not translate into control over physical markets. No algorithm, margin call, or regulatory shift can evaporate metal in a vault. The East-West dynamic goes deeper. China's accumulation of physical silver is strategic, not opportunistic. It represents a worldview where tangible assets and supply chain control define power. The West, particularly the United States, operates on the assumption that financial instruments and digital claims are equivalent to ownership until the moment they are not. When paper prices are manipulated, the illusion of value persists only temporarily. Real value, physical metal, exists independently. That is why the January crash is more than a market event. It is a microcosm of a global shift, a moment when paper and metal, East and West, collided visibly in the financial markets. To understand the stakes, consider the sheer scale of the silver deficit. The world has been in a supply deficit for at least 5 consecutive years. Each year, more silver is consumed than mined. Industrial demand for silver continues to accelerate, fueled by renewable energy technologies, electronics, and emerging tech like AI servers. Yet new discoveries are rare, grades at existing mines are declining, and bringing new supply online can take a decade. The physical metal is finite. Paper, by contrast, can be created instantly, manipulated, and destroyed without leaving a physical trace. This fundamental tension between finite resources and infinite paper underlies much of the East-West conflict in metals. China's moves also illustrate the principle of asymmetric advantage. By controlling refining, physical stockpiles, and export policy, they ensure that even as Western paper prices collapse, the physical market continues to move according to strategic priorities. When US and European traders panic, China buys. When exchanges force liquidation, China takes delivery. The West manipulates digital claims, the East secures actual assets. Over time, this ensures a transfer of real wealth and influence. Paper positions may look profitable temporarily, but they are ultimately fungible. Physical metal cannot be evaporated, margin called, or algorithmically devalued. Even the timing of events reinforces this strategy. The crash coincided with a minor reversal in the dollar. When the dollar began recovering slightly after months of weakness, paper, silver, and gold were crushed. The narrative conveniently attributed the move to dollar strength. Yet in physical terms, nothing had changed. Supply deficits persisted. Industrial demand was still growing. Mints and vaults were still constrained. The paper price's collapse was a momentary illusion. In Shanghai, the metal continued to flow into hands that understood its strategic significance. The contrast between paper volatility and physical accumulation could not be more instructive. Ultimately, this segment of the story reveals a broader lesson about modern financial warfare. The January silver crash was not random. It was a calculated application of rules and leverage to suppress paper prices, protect the dollar, and preserve narrative control in the West. Simultaneously, the East quietly secured physical assets, gaining strategic leverage that no paper instrument could replicate. Futures contracts crashed, accounts were liquidated, losses were enormous. Yet the underlying asset, the metal itself, became more concentrated in the hands of strategic players. One side suffered illusions, the other accumulated reality. It's also not the first time this has happened. History is littered with instances where margin rules and structural mechanics triggered extreme market movements. 1980 saw silver surge from $6 to $50 in a few months, driven by retail enthusiasm and institutional positioning. The response? The CME restricted leverage, effectively forcing cash-only purchases for many traders. Silver collapsed to $10. 2011 repeated the playbook. Massive gains, retail participation, institutional short positions under pressure, and once again margins were raised repeatedly. Silver crashed from $50 to $26. Patterns repeat because structure repeats. Yet while paper wealth was destroyed in the West, the East continued to accumulate. Chinese buyers, understanding the strategic value of physical silver, continued taking delivery. Vaults were drained, mints and refiners were emptied, and the metal changed hands in the real world. This divergence between paper and physical markets is crucial. Paper can be manipulated. It can be margin called. Its value can be reduced with the stroke of a keyboard. Physical metal, on the other hand, is finite, immutable, and real. It cannot disappear because of rules set by an exchange. The lesson for investors is clear. Control the asset itself, not just the representation of it. Looking at the broader context, the East-West dynamic in precious metals is becoming increasingly strategic. China has positioned itself as the gatekeeper for both silver and other critical materials such as rare earths, cobalt, lithium, and gallium. These materials underpin the modern technological landscape. Everything from smartphones to solar panels, electric vehicles, AI data centers, and even advanced military hardware. By controlling the supply chain, China is not just protecting its economic interests, it is shaping the global industrial landscape. This is a form of financial and technological leverage that goes far beyond traditional trading strategies. For Western investors, it means that relying solely on paper markets creates exposure not just to volatility, but to systemic risk. If the underlying asset is constrained, no amount of futures trading can mitigate scarcity or strategic hoarding. Investors must also consider the geopolitical dimension. The world is moving toward a multipolar economic system, and control over physical resources is becoming synonymous with influence. Central banks are increasingly buying gold over treasuries. BRICS nations are building alternative payment systems that bypass the dollar. China is stockpiling silver and controlling refining capacity. Each of these actions reinforces the idea that tangible assets, metals in particular, have strategic value that paper cannot replicate. For those who understand this, the events of January 30th were not a disaster, but an opportunity to observe the forces shaping the global economy and to position themselves accordingly. One practical takeaway for investors is the importance of diversification with intangible assets. While silver alone has strategic value, combining it with gold, platinum, and other critical metals increases resilience against paper-based market manipulation. Investors must distinguish between two types of ownership: claims and possession. Owning a futures contract, an ETF, or a margin position is a claim, an IOU that can be liquidated, margin called, or manipulated. Owning physical metal is possession, a hedge against systemic risk, inflation, and geopolitical disruption. The disparity between these two approaches was illustrated starkly during the January crash. Retail investors holding only paper positions were exposed to catastrophic losses, while those with physical metal were insulated from the volatility. Timing is the one variable that remains uncertain. Nobody can predict precisely when silver will recover or how high it will go once the suppression ends. Prices could fall further in the short term, perhaps even to levels like $50, as forced selling continues to pressure paper markets. Conversely, if supply constraints tighten and industrial demand grows, silver could rebound sharply, potentially surpassing previous highs. What is clear, however, is that long-term trends favor physical ownership. Supply deficits, rising industrial consumption, and strategic stockpiling in the East all point to sustained pressure on availability and upward potential in real terms. Another critical lesson is the value of observing historical patterns. The January 30th crash follows the exact same playbook executed in 1980 and 2011: rapid gains in silver, margin hikes, forced liquidations, and a collapse in paper prices. In both previous instances, silver eventually recovered and exceeded prior highs, illustrating that temporary suppression cannot prevent long-term price discovery. History does not repeat perfectly, but patterns in leverage, liquidity, and systemic intervention are highly instructive. Investors who recognize these patterns can differentiate between short-term panic and long-term opportunity. Finally, the broader message is one of resilience and perspective. Paper prices can crash, accounts can be liquidated, and headlines can panic investors into irrational decisions. But real, physical assets persist. They are finite, immutable, and essential to both industry and strategy. Silver, gold, and other tangible metals cannot be erased by policy or manipulated into non-existence. While volatility may terrify in the short term, those who hold physical assets maintain a hedge against systemic risk, inflation, and geopolitical disruption. The January 30th event was dramatic, but it also reinforced a truth that has held for centuries. Real wealth is tangible, scarce, and enduring. As we close this analysis, one final point stands out. The magnitude of the crash, the speed at which it occurred, and the coordination across exchanges and margin rules reveal the vulnerability of paper-dominated markets. Yet the accumulation of physical metal in the East, the ongoing deficits, and the rising industrial demand highlight the enduring value of silver and gold. One day, the disparity between paper prices and physical reality will narrow. When it does, it is unlikely to happen quietly. The world may witness price corrections that dwarf even the most dramatic collapses of January 30th. Investors who understand these dynamics, who recognize patterns, control physical assets, and track strategic accumulation, will be the ones positioned to benefit in the long term. In the end, Friday was not a crash. It was a demonstration, a lesson, and a signal. The margin hikes, forced liquidations, and paper price collapse were part of a system defending itself. But physical reality, industrial demand, supply deficits, and strategic accumulation persists and grows. East versus West, paper versus metal, fiat versus tangible assets. These dynamics will continue to define markets, influence policy, and shape wealth distribution. For those paying attention, the message is clear. Silver matters. Precious metals matter. And despite volatility, the long-term trajectory remains in favor of those who understand the underlying fundamentals. History has already shown this. January 30th was just the latest chapter in a story that began centuries ago and will continue for decades to come. It's also not the first time this has happened. History is littered with instances where margin rules and structural mechanics triggered extreme market movements. 1980 saw silver surge from $6 to $50 in a few months, driven by retail enthusiasm and institutional positioning. The response? The CME restricted leverage, effectively forcing cash-only purchases for many traders. Silver collapsed to $10. 2011 repeated the playbook. Massive gains, retail participation, institutional short positions under pressure, and once again, margins were raised repeatedly. Silver crashed from $50 to $26. Patterns repeat because structure repeats. The lesson is clear. Markets are not always driven by sentiment. When the mechanics of leverage, collateral, and rules converge, markets can move with absolute ruthlessness. Understanding that mechanism is critical for anyone who wants to survive and potentially thrive in these environments.